Today's episode is brought to you by Curve, a card and digital wallet service. You'll be hearing more about Curve later on, but for now, let's get into today's interview. It's my honor to welcome back to Forward Guidance, Felix Zulauf. Felix, great to have you here. How have you been?
I've been great, Jack. Thank you very much for having me. I'm really honored and pleased to be with you again.
The honor and pleasure is all mine. Felix, we sat down a year ago in December of 2021, and you said that 2022 could be a very unique year and to expect a lot of volatility. Needless to say, that has come true. What stands out to you over the past year in 2022? It's been such a strange year. What did you have your eye on?
To me, it was not a strange year. To me, it was more or less as expected. I predicted a big decline, and that happened. And I expected the decline to be very volatile, which also happened. The biggest change, I think, is what's happening in the global geopolitical arena, really. And I think most investors are not aware of it or do not give it as much credit as they should when analyzing the world going forward. China is a more important trading partner to the vast majority of countries in the world than the US. This is a big change, and the Western world hasn't realized it because we are still looking at the world through our Western glasses of the last few decades, where the US was the hegemon, set the stage, dictated what has to happen, in geopolitics, in military, in economics, etc., etc. And we believe that we can still analyze the world that way. That's not the case. We have a conflict that is building, which I alluded to in many of my reports over the last few years. It's the classic Thucydides trap, where you have the hegemon that is trying to keep the challenger, the upcoming challenger, under control. And that leads to a conflict. And I think that conflict will intensify over the years. It has led also to a war in the Ukraine. This is part of the conflict. And it has all sorts of implications. It will lead to a economic situation where our economies will function much more like a war economy, where you have occasional disruptions and supply chain distortions, etc. And that is not the way we are used to analyze the world economy. And I think it also has implications for the currencies, it has implications for the commodity markets, etc. And when the US used the dollar as a political weapon, as did the European Union, it means that the value of those currencies in the long term will decline because all those nations that are not very close and extremely friendly with those guys will not store their savings, so to speak, in those currencies any longer. So it has tremendous implications. I think we are at the big, going through a process of huge long-term changes over the next few years. So it's a big change. It means that the dominant role is not the way it used to be. It is much weakened and it's not recognized. Look at the G7. 20, 30 years ago, the G7 were the 7 dominating largest economies. Out of the G7, you have 4, Great Britain, France, Germany, and Italy, all together are smaller than China. You see? And India is bigger than France, and things like that. It's a changing world, and it has implications. It's not just going to continue uninterrupted like it did in the past 10 or 20 years. It's different.
And Felix, what are things that were true when the hegemony of the U.S. was unquestioned and dominant that may no longer be true when China could now be eating the U.S.'s lunch? And I'm talking about currencies, talking about asset prices, the economy, central banks, everything. What used to be true that may no longer be?
Okay, if we had a problem with the supply of oil, the US could call up Riyadh, Saudi Arabia, and tell them that we have a contract, we protect your government, and you sell all your oil for dollars, and there is not enough oil around. Please increase the supply of oil. Now, I think that contract is dead because Saudi Arabia will start selling oil for renminbi to China. That means the contract is dead. In the coming weeks, there is a big conference in the Middle East where usually the US president was invited as the keynote speaker. This time it's President Xi from China, not the US. Saudi Arabia is rumored to be building missiles based on Chinese technology. So it has changed. This is just an example.
Felix, a year ago, you predicted U.S. equities to fall something in the range of 20 to 25%. So you kind of nailed it on the nose. Did it happen for the reasons that you expected? And I'll throw out three things. Number one is economy slowing, so earnings going down or growth of earnings going down. Number two is the liquidity deteriorating. And number three is interest rates are higher, so valuations should come down. Which has been the dominant player of that? And going forward, how is your outlook on equities, but U.S. equities, shaped by these three factors?
The most dominant factor is liquidity, or excess liquidity, as we call it, what is left in the financial system that is not being used by the real economy. That liquidity is still deteriorating, in my view. It has improved a little bit over the last 6 weeks or so, and that's why we had a temporary recovery attempt in the markets. I think it will deteriorate again, liquidity, and therefore I think this bear market bounce is over and we go lower, and I think we go into a final low sometimes in late first quarter or something like that. Earnings have not deteriorated as much as I expected because the corporate sector was able to improve their profit margins in the US, in many of the European countries, not in Germany, but in other European countries. And that really meant or resulted in earnings doing better than I expected. I think that is coming to an end because of the economy slowing, because of too high inventories in all three regions, Asia, Europe, and the US. I believe that with weakening final demand, they will have to cut prices of their products. And therefore, I expect profit margins to come under pressure, and so will earnings. And we have a situation where the US economy is pretty different from Europe and China. China is the weakest of all the economies, as I see it. China is in a very serious recession. Do not look at the numbers because they may not reflect the real truth. But China is in the worst recession since at least 2008, if not since the early 1990s. And Europe and UK is entering a severe recession in the first half of next year. And this together is very bearish for multinational companies. And if 50% of the S&P 500 earnings comes from overseas, they come from those regions. And therefore, I think the S&P earnings will decline much more in the first half of 23 than GDP decline would suggest, or weakening of GDP would suggest. And I think that is missed by many of the analysts. So I think we have had the correction so far was a valuation correction due to rising interest rates. I think what's ahead is a correction based on declining earnings or declining earnings guidance, and that will lead to the final low. Whether the final low will be hit in first quarter or not really depends on how the world evolves. If we have a credit event, that would probably be the end of the decline. A credit event is if a company is highly levered and the fundamentals go against them and they default. And usually you find those companies in areas where the leverage is the highest and where you had a huge credit boom before. and where the balance sheets are weak, and that's China. So I wouldn't be surprised to see a major credit event happening in China. If that happened, it would mean that the Chinese have to support the economy, and they will. But they cannot go full speed, because if they did and stimulate like the US would do, it would mean that the renminbi went down dramatically. And then we would have an Asian crisis like in 97. And it would jeopardize China's long-term goals in trade in Asia and in politics. And it would also backfire to the Western world. And that's why I think as soon as we have a major credit event somewhere in the world, most likely in Asia, but somewhere in the world, I think the Fed will change course. It doesn't have to happen in the US. It doesn't have to happen in the US. I think the Fed has also a global responsibility, and they know that. And if they didn't change at that point of time, we would enter a serious calamity on a global basis. And I think they want to avoid that.
Felix, it's brilliant. You just answered the question I was about to ask, which is, earlier on, you painted quite a grim picture of declining earnings all around the world. What would cause equities to bottom in the first quarter of 2023 if interest rates are still high and earnings are going down? You answered it. It's liquidity that central banks will pivot. We will at last get the central bank pivot.
Absolutely, but we will get it only if we get them pushed by certain developments. The ideal development would be a credit event. It will be accompanied by declining inflation rates, I think, because commodity prices are coming down. Import prices will come down because we get the whiff of deflation out of China. And the base effect will also help. So I think those three factors will bring inflation down. Probably not to the 2% the Fed and other central banks would like to see, but the trend will be declining. And if we have a weakening world economy and a severely weakening economy in other parts of the world like Europe and Asia, then I think we likely have some credit event on top of that. Then we will see that the Fed will have to change.
And what might a credit event look like in China?
I think the biggest problem is really Asia and particularly China, because China has gone through the biggest credit boom ever seen in the history of mankind. And we are at the end of that, and we already see the fallout of it in that real estate prices, and we have a vacancy rate of about 20%, where real estate prices are going down, and the banking system has 2% equity capital. Non-performing loans officially are at 1.8% or something like that, and I think unofficially they are twice that. So that means that the banking system is basically wiped out, and therefore the banking system could not even finance another growth period even if they wanted. It's impossible. And based on all this, I think the credit event, if it happens, will most likely materialize in China.
So unlike in the US, the banking system in China is, the government has a lot of control of it. So hypothetically, a bailout would be much easier. But you mentioned earlier that you think such a bailout of printing money would devalue the renminbi, the Chinese yuan. That's really interesting because China historically has run a current account surplus, meaning the yuan would be strong. But they've recycled that by buying a lot of treasuries. So is it possible that China could sell its treasuries in order to make sure that yuan wouldn't depreciate if it had to bail out its banking system?
Well, actually, the Chinese haven't bought treasuries for quite some time. What they have done with the surpluses that they created through the current account surpluses is really that they paid back US dollar denominated loans. And that replacing US dollar denominated loans that were not in the statistics by renminbi denominated loans gave you the impression that they have high credit growth, and that's why many people have been bullish on a recovery in China because they saw those numbers. But it was all misleading. And I think the Chinese will not put more money into U.S. Treasuries. I think they are a net seller of U.S. Treasuries, and they will buy eventually commodities. The problem is, if they really bailed out the system in a major way by printing a lot of money, they would weaken their currency dramatically. And, last time in 94, the Chinese currency devalued by 50%. And a few years later, we had a huge crisis throughout all of Asia. They do not want to do that. And of course, they have a closed currency system because they have capital controls. But still, there is an offshore renminbi, that yuan, that you can trade, and it would go down, and it would lead to a spiking bond yields and interest rates, etc., because the market would still operate it as it would in the Western world, maybe to a slightly lesser degree, but still, I think that would be horrible. So I think what they will do is they will try to use government entities, and they will try to restructure companies and separate them and split them and sell individual parts and let some go bankrupt. And actually, they would be very capitalist in that sense. They would let equity owners go bust and lose everything. That's the way we should do it. That's the way we have forgotten to do in the Western world, So I think they will do the right thing, but they cannot just go full speed money printing as a Western central bank would do. They simply cannot do that.
And what would force the Federal Reserve to pivot if there was a credit event in Europe where the U.S. has a very friendly relationship with Europe? You imagine Christine Lagarde, ECB president, might call Fed Chair Jay Powell and say, you need to slow down the brakes. But as relationships between U.S. and China are very frosty and no longer allies, and it's very much in question, why wouldn't the Federal Reserve say, hey, that's China's problem? At what point would China's problem become the world's problem and the Fed's problem?
Well, at the current time, China and the US are still in contact. And at the recent G20 meeting, what I understand is they discussed how China could support its economy, and the US would be quiet on the Taiwan issue until election of 24 is over. So I think they are still talking, and they both have an interest to not let the global system go down. They both have a clear interest in that, and therefore I think there will be a cooperation.
Hey there, I hope you're enjoying today's show. Just wanted to let you know that this episode is sponsored by Curve, a payment service that gives you power over your finances. The way it works is that Curve is an extra layer on top of your credit and debit cards that gives you additional cash back on the rewards that you're already earning. Curve Card has no foreign transaction fees, and you can choose to earn your rewards in crypto. You don't have to, but you have the option. Curve Card also has a feature called Go Back in Time, where you can retroactively change the card used to buy an item after you made the purchase, up to 30 days after, actually. A key concept in finance is optionality. When you have the option to do something, but you don't have to do something, this can be very valuable in finance as well as life. And optionality is exactly what Curve gives you to do with your wallet. So check out Curve. Go to fgpodcast.link/curve to get $20 once you've downloaded the app and made your first transaction. Curve Card is powered by Hatch Bank. Terms and conditions apply. Now, let's get back to the interview. Felix, if I were to ask you, as the China has become so dominant in the world economy, one would think that the stock market, which should reflect economic growth and profits, would be very positive too. And it was in the first half of this, the first 8 years of this millennia, this century. But since 2009 or 10, the Chinese stock market returns have been quite mediocre, and particularly over the past year and a half, there's been quite an epic crash in the Chinese market. To what do you attribute that, and do you have an outlook on Chinese equities?
when you look at Chinese equities and you try to find a correlation with the Chinese economy, you don't find any. It doesn't correlate. And the Chinese stock market to Chinese investors has never been important because 2/3 of the Chinese savings are invested in the real estate market, which used to be a very good investment for a while. It's not so good any longer because the real estate market is in decline and correcting. But I think the stock market in this economy that is still an autocratic system doesn't play as important a role as in a Western democratic open capitalist system. It's different. I do not see any correlations. I see that there are some great companies, but I do not know whether the conflict will intensify and someday we will see the same result as with Russian equities. There were people saying buy Russian oil stocks because they are damn cheap. Now, you know what? The oil price went up and the stocks got cheaper. They are worthless for the Westerners at the present time. So we do not know what that will mean for China, whether that it will come to that point or not. That's not the desire of China. That is the decision of the West. And the Western decisions recently, since the war broke out in Ukraine or Russia invaded Ukraine, since then you see the biggest loser of the whole situation is not Russia. It is Europe. Europe is suffering the worst. Europe has much higher energy prices than anybody else in the world because Europe has no self-sufficient energy supply. It depends on Russia, which is out now. They sanctioned or boycotted it, and depend on the Middle East. And the Middle East is not as friendly anymore to the Western world as it used to be. When Biden asked the Saudi ruler to increase production, they reduced it by 2 million barrels a day. That has never happened before.
And you can see the struggle Europe is going through just in the currency. The euro has been extremely weak. A year ago when we spoke, you were bearish on the euro, but did you expected the euro to decline, but did you expect it to be as weak as it has been in 2022? And what might the European Central Bank do to strengthen the euro? If it raises interest rates to a sufficiently high level, will that attract capital back in and make the euro strong, or is there less hope than that?
There is simply no way that the Europeans could make the euro strong. If the euro strengthens, it is because the dollar weakens. But the Europeans have no option to strengthen the US dollar, to strengthen the euro by the means of tightening monetary policy or so. If they hiked interest rate too much and if they went to quantitative tapering, then you would probably see some of the governments go bust. So they are trapped. They cannot do that. All you see when you see a strengthening euro, it's basically a reflection of a weakening US dollar. Because the euro is a misconstruction. It is a monetary union of 19 countries in the meantime. I think the euro level, as well as the level of interest rates and the degree of policies, is wrong for all 19. It may be, even if it was okay for the average, there is nobody at the average, and therefore it is a dumb misconstruction, and it will do a lot of havoc to the European economy because there is no economy out there with a structurally weak currency and prosperity in the long run.
Thanks. So I may ask the question in reverse. Why has the US dollar been strong? Is it because the US economy is strong? Is it because the Fed has hiked interest rates so much? Is it because the global economy is so weak? What do you think? And what's your outlook?
Well, usually the US dollar strengthens. It's an anti-cyclical currency. When the world economy weakens, the US dollar strengthens. And that is because when you tighten money supply on a worldwide basis, the US dollar global liquidity tightens. And when it tightens, there is not enough dollars around in the world, and therefore somebody is short and must buy dollars. And the reverse is true. Once the world economy expands, then the system creates more and more dollars. It's not the central banks, it's the banking system, the credit system creates more and more dollars, and as it creates more and more dollars, the dollar weakens. So that's the first thing. The second thing why it strengthened was at the beginning of 21, the Chinese government told their corporations to reduce their US dollar denominated loans by 25%. Because they have huge bank loans outstanding of short-term nature, and we do not know the exact number. The Chinese mentioned once 3 trillion, but it could be 6 trillion easily. We always found out in previous Asian crises that the number has usually always been twice as high as it has been disclosed before. So they had to buy dollars to pay back their dollar-denominated bank loans. That strengthened the demand for dollars and strengthened the dollar. And if the U.S. banks decide we have too much risk out there, we go slower, we tighten the credit standards, and we do not roll some of the bank loans out there to China or to intermediaries, European banks that eventually lend out to the emerging economies, of which China is the biggest one, then of course everybody out there in the world has to buy US dollars, and then the US dollar strengthens. It has nothing to do, or not much to do, with the health of the US economy. It has much more to do with the decision of the US banks, and that, of course, depends on their assessment of the US economy and the world economy.
What is your outlook on bond yields? When the economy is weak, typically bond yields go down. When they're strong, when inflation is high, they go up. I mean, one thing that really stuck out to me is just the very big bear market in bonds globally. Do you think was that because inflation was so high? Inflation surprised to the upside? Is it more due to technical factors? And what is your outlook going forward on treasuries?
Well, our governments thought that they had found the financial perpetuum mobile, and they could just underwrite the economy at any price, at any amount, with any amount, and go into debt, any amount, you just name it, and the central bank will buy all the paper, and there we go, easy. And as long as interest rates, for reasons that I do not want to go into now, have been staying low, that worked. But that worked only up to a certain time. When then came the lockdown period, and in the lockdown period, the different nations had supplied money to consumers to support the economy and strengthen demand. And on the other side, due to the lockdown, supply was constrained. And so supply went down, demand went up, and therefore, in an environment of too large a monetary framework that was pumped up over the years, you had higher prices. And the companies all took advantage of it, and that's why the profit margin of the corporate sector has been going up and not going down in the difficult period since 2020. I think that modus operandi has ended because we have had inflation, and I think this was the first wave of a longer inflation cycle. And we will have declining inflation in most of 23 for the reasons I said before. But if the Fed pivots as we expect, then the excess liquidity that will be created eventually will flow into all the assets that are scarce. Scarcity is the key word. And those will be the commodities where there is a tremendous underinvestment, or where there is a controlled supply due to the conflict of the two systems. like oil, things like that. And if that happens, the commodity prices will go up in the second half of 23 and through 24, maybe into 25. And we could see the price of oil trading at $150, $200 in 24. And if that's the case, then we have double-digit inflation rates in 2024, 25. And at that point of time, I do not believe that bond yields will stay low. They will go up. However, I think there is a window opening for maybe 6 months or so in 23, when the economy weakens, when the inflation rate declines, and when the central banks begin to open the spigots again, that we have a decline of maybe 100, 150, or even 200 basis points in long-term bond yields. But this is just a counter-trend move within a longer-term move to much higher levels of treasury yields. You know, treasuries could trade at 8 to 10% in 25. Our governments are just building up the tower of debt, and there are no buyers. You know, you only have the buyers that have to buy, like insurance companies have to buy some. You had foreign central banks, they will not buy treasuries anymore. I think those on the other side, in the other block, the autocratic block, they will, instead of buying dollars and US treasuries, they will buy commodities and store it inside their own nation. Oil, gold, copper, what have you. And that is safer for them than all of a sudden wake up one morning and getting a message that, oh, your assets are frozen. You see? And I think in that sense, we have entered a very volatile world. And I use the phrase that this decade will be the phrase of roller coasters. And we have now rolled down. I think in 23, with a low in the first part of the year, we will then run up into 24. And after that, I think we will have a big decline again. So this is very challenging for investors, because you cannot sit with a 60-40 portfolio and expect the decent returns that you could achieve in the last 15 years. That game is over.
So on a long-term basis, you remain very bearish on bonds and treasuries, but on a 3 to 6 month basis, you are bullish. And I think it's very good that you outline quite clearly your time horizons. My question is, how bullish are you? If the economy slows only mildly and we have a mild recession in the U.S., maybe the bonds only rally a few basis points, or 50 basis points. But if we have a monumental recession, I imagine they must rally more. Just how bullish are you on treasuries over the next half year, and why?
Okay, first of all, I think for the next 2 months or so, I think treasury bond yields will go up, because the treasury is far behind in issuing paper, and they have drawn down the general account at the Fed, and they have to replenish that account, and they have to finance their growing deficits, and therefore I think the market will be hit by a huge supply of treasuries, and that means higher yields over the next 4 to 8 weeks. And that could lead to treasury yields going up near the former high of 430, or where we were for 10 years. And from there, I would expect a decline of 150 basis points, perhaps even a bit more, for a 6 month period, and that's it. It's a counter trend move. Sharp, short, impressive, but counter to the underlying fundamental trend, which is rising over the next few years.
Thank you. So next 4 to 8 weeks, treasuries could treasuries could sell off. 10-year could go up to as highs of 430 basis points. Then after that, you can have a rally for the next half year down to, I guess that is 280 basis points. But after that, very bearish.
Yes. From 280 to 820. You just something like that, and it will be over several years. We have learned in the 1970s, and I lived through that period. in the first wave of rising inflation, bonds suffered, but relatively mildly. And what we saw this time was relatively mildly. Of course, it was a big move because yields were so low. But
yes.
they only went to 430 when inflation was at over 9%. So that was relatively mildly. I think in the next wave of inflation, that will not be the case. I think in the next wave of inflation, the gap between inflation and the treasury bond yield, the long bond yield, will be narrower than this time. That means bonds will suffer even more in the next cycle. That's from, let's say, second half of 23 into 25.
So that's the longer end of the yield curve, longer duration government bonds. What about the shorter end, which is very influenced by the Federal Reserve? The overnight rate is now at 4%, and the Federal Reserve has been hiking by 75 in later next week. And as a matter of fact, they are widely known to hike by 50 basis points to 4.50%. How high do you think they get? When do they get to 25? When do they stay? And also, you said that the Fed pivot might come, as early as the first quarter of 2023, which is quite close. What would that pivot look like? Would it look like a return to quantitative easing, a cessation of quantitative tightening, merely stop? What is a pivot? Because people throw around the word pivot, but does it mean only hiking by 25? Does it mean not hiking? Does it mean cutting? What does that look like?
Well, the honest answer is I do not know the details. But, if I were Jay Powell, I would look at the situation and say, how do we help the world financial system the best? Of course, we stop tightening. We stop the tapering. We reduce reverse repos dramatically. And they have 2.9 trillion out there. So they could easily reduce that by a trillion or 2 trillion even, and they could even cut interest rates by 50 basis points. I also think that they will make a 50-point hike next week, but I think that should be it for the cycle. And I think
25, no 25 in February.
I don't think so. I think we are already deep into the problems in February. And I could be wrong, but that's my assessment. And I think the free market rates in the money market, they are already topping. I think that's the end of this first cycle. And then we go down into late 23, something like that. So 23 will be a year of a weak world economy, particularly the first half. The US could be the weakest 2 quarters, could be in the middle 2 quarters. And I think towards the end of 23, the world economy will recover. And the liquidity cycle runs ahead of that, and so will the financial markets. And therefore, I think in March, we have major trading cycles. The 40-week trading cycle is due for a bottom. The 80-week trading cycle and the 160-week trading cycle, they are all due for an important bottom. And that's why I think it could happen around that time, later in Q1. I could be wrong by a few weeks, but I accept it. I can live with that.
There we go. So Felix, we covered the long end of the yield curve, the short end. What about the spread? People on Twitter knew I was doing this interview, and people really want to hear what you have to say. People want to hear about, now that the yield curve is inverted, what are you looking at, and how much does that matter? I think the spread between the 10-year Treasury and the 2-year Treasury, close to 80 basis points, which I believe is the biggest inversion since 1981. Obviously, pretty much every recession in the U.S. has been preceded by a yield curve inversion. What does that say about where we are in the cycle for the economy, stocks, and bonds?
Well, it says exactly what I'm telling you, that it's late in the cycle, it's late in the bear cycle, it's late in the liquidity cycle. We are approaching the end of it. I was very bearish a year ago. I'm still bearish, but I'm opening up and prepare myself and my subscribers for a bullish reversal, sometimes in the first few months of next year. And of course, the yield curve will also change. It will also reverse and normalize. That's what I'm expecting. Yes, the chronology of this will be very classic, very conventional. It's just that most people are familiar and know how bull markets work, and they do not know so well how bear markets work. And it's very normal. Bull and bear markets are a result of the liquidity cycle, the economy, and people managing the central banks, and they all are part of nature. And nothing in nature is linear. So if you buy assets 15 years out and believing that it's going to be up in a linear way, that's not the way the world works. It goes through cycles. And we have had a down cycle, which is in the later stage, and I'm looking forward to an up cycle. I know in the media I have a label of a bear. That's not true. It's just because I'm as outspoken in the bear markets as I am in the bull markets. But in bull markets, nobody wants to listen to me. They listen to the classic bulls, which is fine with me.
So if we're in the final phase of a bear market, what does that look like? You said we're late cycle. So far, let's say call it phase one of this bear market has been stocks selling off a little bit. Yes, there are crashes in individual stocks, but the S&P 500 is not down 5% in a day. The VIX is range bound. It's very hard for the VIX to get above 40. The correlation, sort of the correlations between stocks are not as strong. So if one stock is crashing, another stock is going up. So the whole index is not crashing. Now that you say we're in the late stage of this cycle, is it going to be different where everything's going to fall sharply at once, and the VIX finally might go up because people want to buy protection, people get fear? How severe do you think this? You said you're bearish, but is it going to be an orderly decline that we've seen so far this year, or is it going to be a true crash?
I doubt it will be a crash, but it will be a severe decline, and the decline could go into the low 3,000. That was my goal when I turned bearish a year ago, that we go into the low 3,000. We are now in the upper 3,000, so there is still quite a distance to go, and it will be painful. And some stocks will decline less, and some others will decline more. And they will not all make their lows at the same day and in the same minute. It will be through a process of a few weeks, maybe 2 or 3 weeks, and then it will turn around. But I'm following the index because the index is where you eventually get measured against, and I'm looking for buying opportunities. So the decline could be quite severe. As I said, the decline into early October, was a decline based on valuation correction due to the rising interest rates. I think the decline that we see now to the final low will be the decline based on earnings guidance to the downside and disappointing earnings.
Felix, there's someone who asked on Twitter, they want to know, do you think that gold could be used as a payment mechanism for oil?
I don't see that. I think gold will take on a bigger role again in central bank reserves than it has in the last since the early 70s. So a bigger, more prominent role. And I think gold will be an important asset to own. I think gold is in a bottoming process, stretching through the first quarter. We could have a relapse down to the lows we have seen, but I'm quite constructive on gold, and I think it will then rise for several years. And silver will probably even outperform gold, because I think we are in a decade where hard stuff, outperforms financial assets. So I think the commodity cycle will be even more important than the equity market cycle. And that's important. So no, I do not see that will be the case. You know that China is working on an alternative currency that is not fiat, that could be used for settlement of trades. And I think that will eventually come probably around the middle of this decade. and will be used for settlement in trading in Asia first, and then it may spread throughout the world because China knows it has to reduce the role of the US dollar in the world to weaken the US relative to China. It's part of that conflict that I alluded to at the beginning.
So cryptocurrency, Felix, I'll ask you one question about crypto. Trading very much in line with liquidity. So this year liquidity has been very bad, so cryptos have sold off, performing like a risk asset. Do you expect that to continue? And if so, when there is a central bank pivot, do you think that crypto might perform?
First of all, I'm not an expert on cryptocurrencies. I have problem to understand the intrinsic value of cryptos. One cryptocurrency or maybe two or three, I could understand the intrinsic value because you had a limited supply. But when you all of a sudden have, instead of two or three, 15,000 of different cryptos, I don't see the game anymore. You know, this is inflation by itself. So I have a problem with the inherent value. We were lucky, and despite the fact that I'm not the crypto expert, we issued a sell recommendation to our subscribers when Bitcoin traded at 60,000. And we based that on the changing liquidity situation and some of the technical stuff, trend and momentum reading and reading the sentiment in the markets. And it worked out very well. I do believe that there will be a buying opportunity for traders sometimes in the first few months of next year, but I'm not sure that the cryptos will go back to the highs they have seen in the last cycle. I'm not sure about that. Usually the prominent asset class that had the wildest performance on the upside and then crashes is usually an underperformer in the next cycle. But an underperformer also means that it could double in price, but it's still far below the highs that it has been. So you could get an attractive return, but if you hope to get it back to the highs where it has been to, that's probably too much. I don't see that.
Wow, Felix, thank you so much. It's been an absolute pleasure getting a chance to hear your insights. If people want to hear more of your insights in depth, where can they find your work from Zulauf Consulting?
It's www.felixzulauf.com, and there you can request whatever your request is.
Wonderful. Thank you so much, Felix.
You're most welcome, Jack. Thank you for having me.
Thank you so much for watching. A few housekeeping items before I let you go. Subscribe to the Blockworks Macro YouTube channel so you don't miss another episode of Forward Guidance. You can find Forward Guidance, the podcast you just listened to, on your favorite podcast app. That's Apple Podcast, Spotify, Overcast, Podbean. That's Podbean as in, on this pod, I've been saying that the Fed pivot is still far away. In addition, please check out today's sponsor. It really helps the show. Link is in the description. Thanks for watching.